You're listening to the Financial Source podcast on YouTube.
Welcome to the Financial Source podcast. We are looking at a market that is, it is just balancing on a razor's edge right now.
Absolutely.
There's this fragile calm in equities, but it's being tested by gold smashing through the $5,000 barrier.
Mm-hmm.
And while Wall Street is rebounding, you see this massive resurgence of geopolitical risk. We've got fresh tariff wars with South Korea. We have United States warships moving into the Middle East.
It's a fascinating mix of signals.
So today we're going to break down how these trade tensions and military maneuvers are really driving safe haven assets and, what this de-dollarization narrative means for your portfolio. Let's unpack it.
It really is a tale of two markets. You have this surface level stability. The S&P looks fine, tech is holding up.
Right.
But when you look at the plumbing of the global financial system, commodities, currencies, it tells a much more nervous story.
It feels like we're getting two different weather reports. I look at my stock app, it's sunny. I look at the geopolitical headlines, and there's a hurricane warning.
That's a great way to put it.
I want to start with the trade situation because that seems to be the immediate shock to the system. This thing with South Korea, it escalated incredibly fast.
It did.
Yeah.
And for anyone who thought trade policy was going to take a back seat this year, this is a pretty harsh wake-up call. President Trump has announced a sharp tariff hike on South Korea.
And we're not talking small numbers here.
No, not minor adjustments. We are looking at reciprocal tariffs jumping from 15% all the way up to 25%.
Wow. That's a massive hike. Going to 25% changes the entire profit margin calculation for a company. And this isn't just a broad tariff on everything, is it?
No, that's the key. It's targeted. They're going after autos, lumber, and pharmaceuticals.
So the big export engines?
Exactly. The most critical arteries of their trade. And the why here is really important because it looks like sudden aggression, but it's actually a calculated leverage play.
Okay.
The administration is frustrated that the South Korean legislature hasn't enacted the United States-Korea trade agreement yet.
So this is negotiation by brute force. Sign the deal in your parliament, or we crush your auto exports.
Precisely. It's a blunt instrument to force legislative action in Seoul. And the reaction has been immediate. South Korean officials are scrambling.
I bet.
The industry minister is heading straight to Washington. Lawmakers are rushing legislation tied to U.S. investment, just trying to stop the bleeding.
It sounds like the tactic's working, at least in the short term, to get their attention. But what about the long-term cost? When the U.S. swings the tariff hammer this hard against an ally, doesn't that shake confidence in the dollar?
That is the critical connection. That's what you need to be watching. We connect this to the currency markets. The U.S. dollar is trading in a very narrow range. It's showing real softness. This kind of move, it keeps that whole de-dollarization narrative alive and well. It reminds every global trading partner that access to the U.S. market comes with political strings attached.
And markets just hate that kind of uncertainty. If you're a global treasurer, you have to look at this and start thinking that holding dollars is a political risk.
Exactly right. It puts a cap on the dollar's ability to rally. Even with the Federal Reserve reading coming up, the dollar is struggling because trade policy is back in the driver's seat.
And it's not just South Korea.
No. We have to remember, the U.S.-European Union relationship is also in limbo. The European Parliament is delaying a vote on their trade agreement.
So you've got friction in Asia, friction in Europe. The dollar is fighting a war on two fronts.
And that's feeding right into the currency markets. It's why we saw the euro testing that 1.19 handle against the dollar. The dollar just can't break out.
It really does feel like a return to that volatile trade environment. But while currencies are wobbling, there is one asset that is just screaming. We have to talk about this $5,000 number for gold.
It's a historic level.
I have to challenge this a little. We always hear gold goes up when people are scared. But $5,000 an ounce, that just feels different. Is this just inflation? Or is the market signaling that something is structurally broken?
That is the right question to ask. Fear usually gets you a 10, maybe 15% bump. $5,000 is a signal of a structural shift.
Okay.
And this is where the divergence in the commodity markets tells the real story. Gold is reacting to the geopolitical tension. the tariffs, the warships we mentioned.
So it's the ultimate hedge. It's the bunker trade.
It is. Investors are treating every single dip as a buying opportunity. Silver is elevated too.
Okay.
But, and this is where it gets fascinating, if you want to know the health of the actual industrial economy, you don't look at gold, you look at copper.
Right. Dr. Copper. So what is the doctor diagnosing right now?
The doctor's saying the patient is still on life support. Copper failed to hold above $6 a pound. It's fading.
And that's all about China.
Almost entirely the China connection. They're the biggest consumer.
Yeah.
And despite Chinese authorities pumping in liquidity, the demand just isn't there. There's a really uneven industrial recovery.
So you have this incredible split screen. Gold is skyrocketing because of fear and currency distrust.
And copper is slumping because the actual fundamentals of global growth are weak.
Fear versus fundamentals. And right now, fear is winning by a landslide.
It certainly is.
Yeah.
And when you look at the sources of that fear, it is not hard to see why gold is at 5,000.
Let's get into that because we have the Middle East and Ukraine both flashing red at the same time. Let's start in the Middle East. We have United States warships moving.
Yes, a significant ramp up. An aircraft carrier and its warships have arrived in the region.
Right.
That is not a subtle diplomatic gesture. That's a heavy projection of power.
And yet we hear reports that Tehran wants a deal. President Trump called the situation in flux.
Influx is the perfect phrase. On one hand, you have diplomatic signals. On the other, the United States is actively reviewing military options and parking an aircraft carrier on their doorstep.
It's the carrot and the stick, but the stick is the size of a naval sleeve.
Exactly. And then you have reports of Israeli artillery shelling in southern Gaza. The conflict isn't paused. That background noise is the primary fuel for the gold rally.
It's that fragile calm all over again. And then we pivot to Ukraine, where it sounds just as complicated. President Zelensky is talking about ending the conflict, maybe a meeting as soon as Sunday.
On the surface, yes, that sounds like good news. But you have to look at the terms being discussed.
Okay.
The reports suggest that United States security guarantees for Ukraine might be contingent on Kiev agreeing to a peace deal that involves territorial concessions.
So the ultimatum is, we will protect what's left of you, but only if you give up land.
That's the implication, yeah.
Yeah.
And that adds a huge layer of uncertainty. Plus, practically speaking, Western support is hitting its limits. Germany has indicated they cannot supply additional Patriot systems.
Wait, Germany's saying they're tapped out on air defense.
The cupboard is bare, effectively. So you have a situation where military aid is hitting a ceiling and diplomatic pressure for concessions is ramping up. That is not a stable situation.
Which brings us back to the energy markets. Now, usually you hear aircraft carrier off, Iran, war in Europe, and you think oil goes through the roof, but crude is just treading water. Why isn't oil panicking like gold is?
It's the great mystery of the week. Part of it is supply. Kazakhstan is resuming production at its largest field. More oil is coming online. And OPEC Plus is likely to maintain its supply pause, so there's no immediate shortage.
It's just balance.
It's a fragile balance. But the real aha moment in energy this week wasn't global. It was a domestic policy proposal that caught everyone off guard.
Oh, you mean the California proposal? I had to read that twice. President Trump floated the idea of capping California's state fuel tax.
Yes, to drive down gasoline prices.
I mean, can he actually do that? That sounds like a massive intervention in state rights.
Well, whether he can legally do it is a question for the lawyers. It would absolutely face a court challenge. But the fact that he's floating it is what matters to the market.
Oh, so?
It signals a willingness for the federal government to intervene in state-level taxation to control prices. That adds a political dimension to domestic energy pricing that markets just had not priced in. A whole new variable of risk right here at home.
Just another layer of complexity. Let's look at currencies again before we wrap up.
Yeah.
We said the dollar is soft. What about the Japanese yen?
It's been on a roller coaster, but it is recovering. It's rebounding from those levels below 154 against the dollar.
Is that just dollar weakness, or is there something happening in Japan?
A bit of both. But the domestic data matters here. Japanese services producer price inflation is a little cooler, but it is still above the Bank of Japan's target.
And services inflation is the key for them, right? That suggests wages are finally moving.
It's crucial. It's exactly what the Bank of Japan has been waiting for. It keeps the pressure on them to normalize policy, which supports the yen.
So things are moving there. And we saw the euro and sterling testing higher levels, too.
We did. The euro tested the 1.19 handle. Sterling was near 1.37. But again, nothing is really breaking out. Everything feels like it's in a holding pattern.
Waiting for the Federal Open Market Committee decision.
Exactly. Everyone is holding their breath for the Federal Reserve.
It feels like everyone has placed their bets, buying gold, selling copper, and now they're just sitting on their hands.
That is the fragile calm we started with. Volatility looks low on the surface, but the macro undercurrents, the tariffs, the wars, the central bank policy, they are powerful currents.
It's like a duck on a pond. Calm on top, paddling like mad underneath.
That's the perfect analogy. And any one of these threads could snap this week.
So for you listening, watch the trade headlines, keep an eye on that $5,000 gold level, and don't assume that quiet markets mean safe markets.
Precisely. That divergence between gold and copper is your dashboard warning light. When gold is sprinting and copper is limping, be very careful with risk.
Thanks for listening to the Financial Source Podcast. See you next time.
Appreciate you tuning in. Join us again on the Financial Source Podcast.